All right, welcome to another day of the live revision. Today is day 4, and we'll be solving our mock papers as we did yesterday. Uh, so, this one we are doing a June 21 paper, and well, this is how the exam would be, as in, again, this is on the spreadsheet, not the CBA platform. So, I'm Paritosh Panchal, and let's begin for the day. This is just your general instruction, so we'll just skip that. You can read it later. Okay, question number 1. I hope the screen is visible. Let me just check. This is just your general instruction. Okay, it seems proper. All right. So the following, okay, first we read the, okay, so since this is already split in sections, so we can read the requirements first over here. Let's just read everything. The following exhibits available on the left-hand side of the screen provided information relevant to the question. Introduction, that is firstly about Chakula and the demerger of Kava and Lala company as a prospective buyer of Kava company. Areas for further clarification requested by Lala company. Capital structure details for all the companies, Kava company as a demerged company, and acquisition of Kava and Lala company. Okay, so these are the criteria as in the sections to the question. The information should be used to answer the question requirement within your chosen response option. Scenario number 1, requirements is explain why the regulatory framework related to mergers and acquisition is necessary to protect the interests of the shareholder and other stakeholders. Now, this is a theory question which can be answered as it is without even reading the question. We have to talk about why regulatory framework is required for mergers and acquisition and how does it um, protect the interests of the shareholders and other stakeholders. All right. So very simple. So firstly, we'll focus on the shareholders. If you think from the shareholders' point of view, how do these framework help shareholders? Well, it protects the interests of the minority shareholder. Okay, and also, sometimes what happens is the target company's management does not want to take over. Why? Because there is a chance that they may lose their job. So they'll try to block it. But if you have regulatory frameworks in place, then it could even, not let that happen. Okay. So though it is in the interest of the shareholders, but the management would block it, that shouldn't happen. And there is enough time for the shareholders of the target company to propose the deal, as in to go through the deal and make a decision. Adequate time is given. So these are some points which is going to help the shareholders and other stakeholder at large. Now, the mergers and acquisition, the regulator ensures that after the merger or acquisition happens, it should not become like a monopoly. There should still be healthy competition. Okay. Because healthy competition is required. If there is monopoly, then that person can even take undue advantage of its monopolistic position and can even exploit customers, which we do not want. Wait, let me just fix the light. Okay, I think this is proper. Wait a minute. Yeah, seems better now. Okay, so one quick disclosure. My internet today is a little choppy, so if there is any disconnection or anything, let me know. Usually I get a notification, but at times that notification is delayed. Anyways, let's continue. Um, So discuss the two theoretical propositions as raised by Lala's board of directors in relation to company's capital structure. So for this, we'll need to read the question and prepare a report for the board of directors of Lala company, which will estimate the value of Kava company share if it is demerged and listed as an independent company. Then we have to estimate the additional equity value created when combining Lala and Kava, percentage gain of each Lala company and Kava company shareholders under each payment method, impact of Lala capital structure under each payment method, and evaluate the financial and other factors that both Lala company shareholders and Kawa company shareholders would consider prior to agreeing to the acquisition, and the impact on Lala company's capital structure under each payment method. Professional marks will be awarded. Now, this is an old question paper. That's why professional marks, only 4 marks are there. But now for your exam, it will be 10 marks. Okay, so it may not be as big as this question if you get something similar. Okay, probably there would be something less and you will get 6 marks extra for your professional. So total 10 marks professional. All right. Now we have to find, so basically it's some sort of mergers and acquisition deal. So let's read the case. You have to write a report. Now, report, we have already discussed the format on day one, and even yesterday we had seen the report. So, to the board of directors, now this report is to be written to Lala company. Okay, so to the board of directors of Lala company, from the financial manager, subject evaluating acquisition of Kawa company and other details relating to the deal. Okay, and then you can start off with the introduction. So in the introduction you can just write a report evaluating the financial and other factors that both Lala company shareholders, so all of this, so from here only you can pick up the introduction part. All right, then you can do the estimation and evaluation of it with appendix reference and then other factors to consider, all of that. Okay, whatever is being asked needs to be covered. So let's read the question now. Chakula Company is a large listed company involved in two business sectors. Its main business is in the production of food and drinks for supermarket and other large traders. It also owns a chain of coffee shop nationwide. Chakula Company's board of directors thinks that the company is undervalued and is of the opinion that it should focus on rapid innovations taking place in the food and drink production sector. Therefore, Chakula's board of director has decided to unbundle the coffee shop's business into a company called Kawa Company. Chakula Company will then either demerge Kawa through a spin-off or sell Kawa Company. So there is a Chakula Company, okay, who has a couple of businesses. One of it is so it is in the production of food and drink, but it also does coffee shop retail, okay, retail through a coffee shop, and their coffee shop's name is called Kawa. Now, they are thinking of demerging Kawa or selling Kawa off to unlock the value of Chakula. Now, Chakula will then turn its full focus on its remaining business of food and drink production. Initially, Chakula company shareholders will own Kawa company on basis of owning one Kawa share for every Chakula share owned by them. So, even if they spin it off, okay, then they will still, the existing shareholders of Chakula will get one share each for every share that they hold. So the ratio is 1:1 ratio. I'm just writing it down over here so that we know. Let me just highlight it over here. Okay. Lala is a large unlisted company controlled by 20 shareholders who all have a significant stake in the business. Lala company owns a number of hotels around the country and is looking to diversity into the coffee. I think it's diversify into the coffee retail business. Lala, let me just correct it. Olive, it's fine. You understand, okay? Diversify into coffee retail business. Lala company has approached Chakula about the possibility of purchasing Kawa company, and Lala company will finance the purchase either through a cash only offer or a share for share offer. If Kawa company is demerged, it will be listed on the stock exchange as an independent company. Chakula company is unsure whether to sell Kawa company to Lala or to demerge it into an independent company. So if it's demerged, it's going to get 1:1. If they sell it off, then Lala is either going to give cash or share for share offer. So three options they have: spin off, sell it against cash, sell it against shares. Now, further clarification has been sought by Lala's board of directors in the following two areas. Lala's CEO has determined that a regulatory framework in the area of mergers and acquisition is designed to protect the interests of the shareholders and other stakeholders. She wants to find out whether there is a need for a regulatory framework. There very well is a need. We have already discussed the advantages for shareholders as well as other stakeholders. Okay, how does it protect their interest? We have discussed initially. Also, for more, you can refer to your notes or the study text. The acquisition of Kawa Company will be a major investment of Lala Company, and its board of directors has concerns about the acquisition will be financed. The board of directors has heard that there are several theories explaining the capital structure of a company, including following two propositions. A company would maximize its debt financing, okay, or a company should rather maximize its debt financing. Well, this is based on the M&M's theory, okay, with tax theory, wherein, so you can write about that, wherein he has, so M&M had initially suggested that the company should be 99.9% funded by debt. The reason being that is a cheaper source of financing. You enjoy a tax shield on it, so therefore use maximum debt, okay, to bring down your overall cost of capital. And but the traditional theory builds on it or says otherwise, saying that if you have more and more level of debt, it could lead to financial risk, and the cheapness of debt may not be able to compensate the increase in cost of equity after a certain uh, gearing level. Okay, so initially the cost would drop, but then later, if it reaches a very high level, okay, then the WACC would increase. So you are supposed to write about or refer to both these theories and explain why some people say maximize debt and why some people would say that there should be a balance between a debt and equity. Okay, the better way in real, this works better more than 100% or 99% of debt financing. Okay, so you can write those, you can refer to your notes or the study text and draft your answer accordingly. Extracts from Chakula Company's financial statements are as follows. Asset and liability 5,000 and wait, assets and liabilities, assets less current liabilities 5,000 $10 million. Then it is financed by a share capital of $100,000. Reserves is of 1,180. Non-current liabilities is 2,470. Non-current liability, which is another loan, which is called B, loan notes B, is $360 million. Shakula Company shares are trading at $2.45 each and has an equity beta of 1.3. The part of the business which will become Kawa Company accounts for, sorry, the part of the business which will become Kawa Company accounts for 24.5% of Chakula Company's total equity value. Chakula's loan notes A. So let's just start working with these figures immediately. So what they are saying is Chakula Company shares are trading at 2.45 each and have an equity beta of 1.3. The part of the business which will become Kawa accounts. So Chakula Company's share price, okay, is $2.45. Okay. Number of shares in Chakula will be, so this is the nominal value divided by 0.5. So these many million shares, this is per share. Okay. So $2 million, sorry, not $2 million, it is just 2 million is the number of shares in Chakula. And we read earlier that the ratio was 1:1. So number of shares of Kawa will also be 2 million, sorry, 2 million shares. All right. Then what else they have said that the equity beta of Chakula is 1.3. The part of the business which will become Kava accounts for 24.5% of Chakula company's total value. So the equity beta of Chakula is 1.3. All right. And the business which will become Kava accounts to 24.5%. So if we say market value of Chakula, there are 2 million shares into $2.45, so 2.45. Okay, these many dollars, $4,900 million is the value of Chakula. Okay, and therefore market value of Kava will be this into what's the percentage? 24.5%. Okay, so $1,201 million will be market value of Kava company, right? Uh, that's the information we got from the first paragraph. Now, Chakula Company's loan notes A currently have a total market value of $2,100 million and loan note B is $400 million. So this is actually worth 2,100 and this is worth 400 million. Okay, this is the market value you can say. Uh, the pre-tax cost of debt has been determined at 4.3% for loan notes A and 4.1% for loan notes B. Okay, 4.3 and 4.1%. Okay, this is the cost and it's pre-tax, right? After the unbundling, loan notes B will be serviced by Kava and loan notes A will remain with Chakula company, but the pre-tax cost of debt for both will increase by 0.3%. It is expected that Kava company will maintain its capital structure after unbundling. So 0.3% it will increase. Okay, before we proceed with this, wait, let's just go back to the main requirements. Yeah. What are we first supposed to do? We are estimating the value of Kava company shares in the demerged, if it is demerged and listed as an independent company. Okay, so we are trying to do that. So first, let's just write this. Okay, when we are doing the calculation here, so we are just writing the right appendix one, that is estimating the or estimate also we can write estimate uh, the value of Kava company and its cost of capital. Okay, or we could write two different appendix. Let's figure that out a little later. Okay, but we first need to estimate the value of Kava company. Right? Maybe we can just write this and let's see. Uh, yeah, as we are reading now, so they say that Kava will take care of the loan notes B and their cost will increase by 0.3%. Lala company's debt to equity ratio is estimated to be 40 is to 60. This is Lala company. Okay, so write this also over here. debt to equity is 40 is to 60. Okay. Right. Okay. Since it wasn't being formatted properly, so I just wrote it this way, just for our information, so that we don't get lost, don't miss out on anything, basically. Uh, and has 1,200 million shares in issue. Number of shares in Lahla is 1,200 million shares. Okay. The coffee retail industry is dominated by Booni Company, a large listed company which owns many coffee shops, and the average asset beta for coffee retail industry is 1.15. Okay, that's the asset beta of Booni Company. So normally we are given equity beta of the proxy or the industry, and we have to ungear it and find the asset beta. But in this question, they have given us the asset beta directly. Okay, so 1.15 is the industry's asset beta. Okay, or which industry? Coffee retail. So coffee retail industry is asset beta. All companies pay corporate tax at 20% per year, and the tax is payable in the same year as profit it is based on. The risk-free rate of return is estimated to be 3%, and the market risk premium is 7.2%. So all this is relating to um, cost. Okay, so let us find the cost first. So instead of first finding the value of cover, because we discount it and no information is given about that, let's find the let's estimate the cost of capital of Kava company. Okay, so what will be the cost of equity, cost of debt? Now, cost of debt is relatively easy. So, cost of debt, and this is all after, after demerger. Okay, cost of debt for we need for our WACC, we need post tax cost of debt. Okay. Now, they have said that the pre-tax cost of debt we have written over here is, let me just copy paste it. Okay, pre-tax cost of debt is this much, and we have to do post-tax. So into the tax shield, 1 minus tax rate is 20%. Okay, so the percentage, it is 3.52%. Now let's find cost of equity. Okay, now how, just hold this. Yeah, cost of equity. Now we have equity beta. We have equity beta of the entire company. Where is it? Over here. Okay. And we have asset beta of only the coffee business. Okay. So we'll take, see, the business risks of coffee retail, and Kava is coffee retail. Okay. So asset beta of Bunico, which is coffee retail industries average, or was it of, okay, industry average. So it's just Bunico is just the company's name given as is. We are taking actually industries asset beta. So you just coffee retail industries asset beta is 1.15. Okay. Now we are going to gear it as per R beta. Okay. As per our gearing. Now we know that so cost of equity is equal to risk-free rate plus beta, or rather equity beta, into market premium. Okay. Now out of this we have the risk-free rate 3%. We have the market premium to be 7.2%. Okay. Now we need to find out the equity beta. Now, some students will take the equity beta of Chaluka, which is incorrect because Chaluka has both the businesses. Okay, we have to find only coffee retail. So, asset beta, now the formula for asset beta is asset beta is equal to equity beta into value of equity divided by value of equity plus value of debt into 1 minus T. Okay, this is how it is calculated. So let us first find out what is the value of equity. The value of equity for Kava is here. Okay, we have already calculated it. So this is the market value of, okay, it's basically market value. Okay, and then value of debt will be, so they have said that the debt will get revalued at 400. Okay, so value of debt is 400, and we are going to do VD 1 minus T. I'm doing all calculations separately so that you understand what I'm doing. You can do it directly also. You need not show so many steps. Okay. So this is 320. Now we already have, okay, so now we can calculate our equity beta. So equity beta will be asset beta. Okay. So if we say, wait, let me put in one more, or I'll do it directly only. It's easy to understand. Asset beta, and now the denominator becomes the numerator and numerator becomes the denominator. Okay, so into this plus this, sorry, value of equity. Okay, divided by just the value of equity. All right. So 1.46 is the equity beta. Therefore, the cost of equity will be your risk-free rate. So the risk-free rate is, let's just write these down. Now, RF is how much? 3% and 7.2%. So 3%, 7.2% is the market risk premium. All right. So cost of equity will be your risk-free rate plus equity beta into the risk premium, which is 13%, or if you want to 13.5%, you can say. Okay, so cost of equity will be this, right? This also over here. Both show just one decimal place for both. Okay, so 3.5 and 13.5% is the respective calculations. Okay, now we found equity beta, right? Now we have to find out WACC. Okay, so WACC. For that, we'll first equity debt. Okay, the cost for equity is 13.5%. Cost for debt is 3.5%. Now the market value for equity is this much, and the market value for debt is, okay, we didn't write, oh yeah, we had written it over here. Okay, loan B is taken over. Okay, this is the market value of debt. This is in $1 million. Okay, so therefore total will be, so the weights will be this. Okay, therefore WACC will be the weight into the cost. Again, I have made a table so that you understand it better. You need not make the table. You can just in one sentence only just do the final calculation. So this is our WACC. Okay, so this is the final thing that we need from here. That is WACC. Okay. Just formatting it better. Right. So 11% is the WACC for of Kava company demerge. All right. So this is our Appendix 1, estimating the cost of capital of Kava company. Now, with this information, we can proceed to the next one. So, Kava as a demerged company. Now, the following estimated information will be applicable to Kava company if it is demerged. Chakula company's sales revenue is $4,500 million currently, of which 20% is attributable to Kava company. So let us write what is the sales revenue of Kava company. Okay. So sales or current sales of Kava company will be equal to 4,500 million into 20%. Okay, so $900 million is what is the current sales of Kava company. It is estimated that after Kava company's demerge, its annual sales growth rate will be 6%, and the profit margin before interest and tax will be 21% of sales revenue for each of the next 4 years. Okay, so we are doing a forecast of next 4 years. So let us write that. Years sales and profit before interest and taxes. Okay, so year 1, 2, 3, and 4. And they are saying that sales is growing at will be at 6%. Okay, so currently it is this into 1 plus 6%, right? So 954 is the sale. Wait, into plus 6%. So this is our sales. Now profit before interest and taxes, which is our operating cash flow, you can say. Okay, will be 21% of the sales revenue. 21%. Okay. Now remember, all these figures are in million dollars. So dollar million. Okay. Now what else? It can be assumed that the current tax allowable depreciation will remain equivalent to the amount of investment needed to maintain the current level of operations. Okay. So see, in your free FCFF, okay, if you have to calculate your free cash flows, all right, the formula usually is, okay, for FCFF, the how we usually write it is EBIT 1 minus T. Okay, that is post-tax operating. Then we do plus non-cash expenses. Okay. Oh, okay. Then less changes in your working capital. So current asset minus your current liability. Okay. Then you will do less any sort of capex. Okay. Capital expenditure. And you will get your free cash flow. Okay. This all will lead to your free cash flows. Okay, just there's like a brief this thing of free cash flows. So we are just following the same. We already have our EBIT. Now we are supposed to do 1 minus T. Okay. Taxes we'll come to shortly. Let's see what the tax rate is mentioned over here. Okay. Uh, or is it after tax? No, before interest and taxes, they have said. Okay, so it's not after tax. For each of the next 4 years, it can be assumed that the current tax allowable depreciation will remain equivalent to amount investment needed to maintain the current level of operations. So what they are saying is that what we are supposed to reduce, that is, sorry, add, that is non-cash expense, will be equal to our capex. So it gets nullified. We need not take that into consideration. Okay, but that Kava company will require an additional invest in asset of 0.25 for every $1 increase in sales revenue. Every $1 increase in sales revenue, okay, increase, not the total sales, but increase in sales revenue. All right, so what is the increase in sales revenue? Um, or I'll just wait, increase in sales revenue. Okay, let me just take all of this a little. All right, increase in sales revenue. So for in year 1, it was this minus 900 million. Okay, then for year 2, it is this minus this. Again, you can do it directly, but I'm just showing it to you over here. Okay, this is increase in sales revenue. So your additional capex, will be this. For every $1, it is how much? $0.25. Okay. So this is our additional capex. Now we also have to do less tax. Okay. Okay, and capex is also an outflow. Okay, see, PBIT is nothing but inflow. You do need not write all of this. It's a revision so that you understand everything. Okay. So yeah, less outflow. So additional capex. Now, yeah, taxes. So tax will be 20%. We read that previously. Okay, so this will be tax outflow. Now, nothing has been mentioned whether it's in 1 year, arrears, or something like that. Per year, and tax is payable in the same year as profit. Okay, so same year taxation. So there is no 1 year arrear, no lag. Okay, so let's read further. After the initial 4 years, the annual growth rate of company's free cash flow is expected to be 2.5% for the foreseeable future. Okay. Oh, before that, we first need to mark this. Okay. So this is our appendix number 2. Remember everything appendix with proper titles. Okay. Estimate the value of, or the equity value of Kava company post demerger. Okay. And this is what we are calculating over here. So if you see the way question is structured, mostly one paragraph you can do one calculation, next paragraph you can do some other calculation. So as in calculation in the sense, relevant information is available. Okay. So your free cash flows will be PBIT less taxes less additional capex. Okay, so $147 million. Okay, this is your free cash flow. Now, if you have to discount it, PV at the rate of cost of capital, which we calculated earlier, was 11%. Okay, so is equal to. Now we need not, since we have the NPV's formula available to us. Okay, so we can just do is equal to NPV bracket open 11%, comma, and then we can just select all of these. This is the value. Okay, this is the total present value. Okay, these many $1 million. Now this is for 4 years forecasting. Now after 5th year, what is happening is, okay, 5th year till infinity, they are saying that it will grow 2.5% growth. Okay, what is growing by 2.5%? The free cash flows. All right. Now 5 years to infinity, it is 2.5% growth. So we'll use our perpetual discounting, okay, formula. So free cash flow on year 5 will be this into 1 plus 2.5%. Okay. $179 million. Okay. But we are going to use the terminal, so we can say the terminal growth rate is 2.5%. Okay. Now what we can do is we can find the terminal value. All right. We found the present value of the 4 years. Now we can find the terminal value of as in from year 5 onwards. Okay. So PV of terminal value, it's perpetual discounting, so is equal to cash flow, or we could have done 175 into 1 plus 2.5%. Okay. So cash flow divided by KE minus G. So KE is 11%, minus G is 2.5%. Okay. Now this is the terminal value, PV of terminal value as on year 4. Okay. Right. So we have to further discount it. PV of terminal value as on year 0 is equal to, we have to double discount it. Okay, now we don't know the annual discounting factor since we directly did the calculation, so we can just do into 1 divided by 1 plus R, or we can directly just do divided by 1 plus R. We are discounting it at 11% raised to 4 years. Okay, so $1,389 million is the present value as on year 0. Okay, so this is the other one we need. All right, so total value of Kava company will be this plus this. Okay, that's the total value of Kava company. This includes both debt and equity. All right. Now we already know that the debt to equity ratio for it is 75 and 25%. So 75% is equity. Therefore, value or equity value of Kava company, which is 75%, is this into 0.75. $1,000 million. Okay. This we can highlight. Okay. This is the equity value of Kava company. Now, if we want to find, we can find out the per value share also. Okay. So per share value of Kava company demerged will be, now number of shares was, number of shares was equal to, we had the number of shares over here somewhere, 2 million. Okay. So it will be this divided by 2 million. So it's, let's see, let's open it up. $0.71 per share. Okay. There is the per share value of Kava company. So what is the gain that, or we can just say Kava company's original share value? Okay. Originally, we had valued it. What did you value it at? So value of equity we said was this divided by total number of shares, that is 2. Okay. So originally it was $6 points or 60 cents per share. Okay. Therefore, the gain on demerger is this divided by this minus 1. Okay. Wait, sorry, wrong. It's grown to this. Okay. So 17% is the growth. Wait, has become 0.71, or let's just try another way. If we see the difference, it is this minus 60 cent divided by 60 cent. Okay, yeah, it's the same thing. Yeah. So 17.6% is the gain, all right, for Kava company. Okay. So this is the gain that it would make if Kava was demerged. All right. Let me just a moment. If I all right. Okay. This is the gain on demerger. Now, if you were to write it individually, okay, you would get 18.3%. Individually, as in if you were to take 0.71 divided by zero point 0.6, okay, then you are to get 18.3%, or if you can just say that is one way of doing it, or this minus 1 will give you 18.3%. Okay. But since we have taken the entire value of share, okay, it's not really 0.71, it is 0.7061, whatever. Okay, and this also may not be 60 cents, it is 60025. Okay. So if you just take it to 2 decimal places, you would get 18.3%. But if you are taking the full value, you are going to get 17.6. Whatever you do, both answers are correct. So don't worry. All right. So this is the gain on demerger for Kava company. And yeah, so we found the value and the gain. Now moving on. So if we see from our requirements, we had to estimate the value of Kava company share if it demerged and listed as an independent company. Okay, so question 1C subsection 1 is done. Okay, you can always label it question 1C. In fact, you must always label it. Even the previous one could have been labeled that way. Let me just okay, right. Now, moving on. So the following estimated information applies to acquisition of Kava company by Lala. So this mostly is relating to our next. This is done. Now estimate the additional equity value created when combining Lala and Kava. Percentage gain to each Lala and Kava shareholder group under each of the payment and impact on Lala's capital structure under each of the method. Okay. So we have to calculate all of this. This is for 12 marks and this whole thing is for 11 marks. Then we have to evaluate also. So yeah, the following estimates apply, information applies to the acquisition of Kava company by Lala company. If Kava company is acquired, the average PE ratio for hotel industry is 15.61. However, Lala company's PE ratio is estimated to be 10% lower than this. Okay, so Lala companies, okay, PE ratio is 15.61 into 10% lower. Okay, so that's into 90% also you can do. So the PE will be 14.05. Okay. Uh, Extracts from the current statement of profit and loss applicable to Lala companies, Lala and Kava company are as follows. Profit before interest and taxes, interest, tax, PBT. Okay. Now, after acquisition, it is expected that the PE ratio of the combined entity will be the midpoint between the two individual companies' PE ratio. The annual after-tax profits will increase by 62 million due to combining the two companies. Lala has proposed to pay for Kava company either through a cash offer of 0.66 or 66 cents for a share of Kava company or one Lala share for every three Kava shares. Lala company will borrow the money needed to pay for the acquisition. So it does not have the money, it will borrow it. Okay. Now we have the PE of Lala. So with this, we can find the current value of Lala company. So company's current equity value. This is pre-acquisition. Okay. So PE into earnings. Lala is doing 171. Okay. So these many dollars, $1 million. Okay. This $2,402 million is the value for Lala, which is pre-acquisition, okay, before it has acquired any shares. Now, Kava's equity value before acquisition, okay. Now, we have already calculated the value of a Kava company, okay. Where is it? Now, this is before acquisition or before anything, okay. So, we took the value of so before demerger, because demerger was option number one. So you won't take the demerger value. You will take pre-acquisition value. Okay. This is Kava company demerged. Okay. This is demerged company's value, 1,412. This is before demerger that we found out. Where did we find it from? Here. Okay. So we'll be taking that. Keep that in mind. Right? That's the Kava company's individual pre-acquisition value and Lala's individual pre-acquisition value. Now, what will be the PE of Kava? Because we have to take the average. All right, PE will be price divided by earnings. So this is the price divided by earnings. Now it's not a dollar sign. Okay, it's a PE ratio. So 10.5, or sorry, 10.25. Okay. Now average PE of the combined entity. Okay. So it will be is equal to both the PEs divided by. So 12.15 is the PE for the average PE for the combined entity. Now, what is the profits? Okay, profit after tax of the combined entity. So it will be Lala's profits, Kava's profits plus. Now they have said that 62 million is additional annual after tax profits. So plus 62 million. Okay. So these many $1,000,000, $350 million is the after tax profit of it. So if we have to find the estimated equity value of the combined entity, okay, this $350 million into the PE multiple, that is $4,254 million. Okay, this is the total value of the combined equity. That means the synergy benefits or additional equity value created from combining VINING and combining the two companies, that is synergy, okay, will be. Now we know that the total value of the company is this minus, if they were individually to be added, then their individual valuations, $605 million. Okay, so this also we can combine. I can just highlight this, and then we know what is the combined value. So this also we can label. All right, appendix. So this is our sale of Fava company to Lala company and value of combined entity. Okay, so yeah. Now what else is given to us? Lala has proposed to pay for acquiring. So there are two ways that they are going to offer. One is cash offer Okay, so what is the cash offer? Has proposed to pay for acquiring either through a cash offer for 0.66 for Kava per Kava share. Okay, so cash offer is $0.66. So now Kava is basically Chakula. So Chakula companies shareholders will receive 66 cents per share from sale of Kava company to Lala. Okay, that means 0.66. Okay, so total cash received by shareholders of Chakula. Okay, so now there are 2,000 shares of Chakula. Okay, it was same 1:1 ratio. So we already know that there are 2,000 shares. Okay, so we can just 2,000 million. Okay, wait, where was it? Yeah. So per share, they are getting 0.66. So $1,321 million is what they are getting in total. Okay. Now, what was the per Kava company's pre-acquisition per share price? Okay. Now, what was the share price of Kava company? Is it over here? We had calculated it. Yeah, Kava company's original share value is this much. Okay, without any demerger or anything, was zero point 0.6. So Kava company's per share price was 0 0.6. That is unmerged, like estimated. This is estimated. Okay, we can find it in Appendix 2. All right, we have, or rather, this again is taken from Appendix 1. Okay, so in fact, just write it over here. Per share price of Kava company is equal to this divided by this. Okay, so we can say Appendix 1. Right? So 0 0.6 was the estimated. So what is the gain that they are getting? Gain will be, or is equal to, now they are getting 0.66 instead of 0.6 plus 1. This is nothing but just a percentage gain. Okay, so simple. 10% is the gain. So over here, if it is gain in case of cash offer by Kava companies shareholders, or rather Kava company is basically Chakula only. Chakula company shareholders in case of cash offer is 10%. If they would have done a demerger, they would get 17.6. So they would not want a cash deal of 10%. Okay. Now, what impact does this have on Lala company shareholders? So Lala company's total shareholders holders value, okay, or estimated rather. Now, Lala company, if you have to see, they are the combined entity is worth this much, okay, because after acquisition, they are going to acquire the entire entity, okay, as in Kava, so they become that combined entity, but they are paying cash, okay, so 1,320 million is the outflow. So 2,934 million is the value of uh, the total shareholders value for Lala company. Okay. So if you want to see what is the per share price, okay. Sorry. Uh, and just copy this. Now per share. So is equal to this divided by how many shares do Lala has? Shareholders do Lala have? I think it was the previous, there was a debt to equity ratio available to us. Wait, somewhere we had written number of shares in Lala is 1,200. Okay, so that is, let me just write it over here. Number of shares in Lala's is equal to 1,200 million, and this is a number. Okay, so it will be this divided by this, so $2.44 per share. Okay, so Lala company's original, this is per share. So originally Lala company was worth 2,402. Okay, but now it is worth $2.44. Okay, so the gain by Lala company shareholders will be 22%. Okay, this is the gain, or it's just 22%. So the cash deal, Lala company shareholders will be very happy, but Chakula may not accept that offer. So a cash deal may not be a likely deal to happen. It will be rejected by Chakula. They would say we would rather demerge the entity and our shareholders gain much more. That is around 17%. Okay, we can just, oh yeah, 18% we can say. Okay, just to show the distinction over here, 17.6 or 18%, whatever. So which is much more than the cash deal. Now let's assess the share for share deal. So, or one Lala share for every three Kawa shares. Okay, one Lala share for every three Lala shares. Right? Now, wait, let's just read. The Lala company will borrow needed money needed to pay for the acquisition. So in this case, it will have to borrow. But now, if it is doing a share for share deal, so share for share offer. Okay, this was a cash offer. So we can in fact just underline it. Okay, here we don't have underlining option, but in your CV platform, you have underline. So you can underline the headings, make it neat and presentable. There are marks for it. Okay. The examiner should understand each sections very easily. So additional shares issued by Lala company. Okay. So it's going to issue one share for every three shares of uh, Kawa company, and Kawa company has how many shares? It was 2000. Where did I write it now? I think it was in the previous question. Yeah, 2000 shares, 2000 million shares. Okay, so it is going to issue 667 million shares. Okay, now the equity value of the combined entity is, okay, equity value of the combined entity is $4,254 million. Okay, therefore, per share value will be this divided by now total number of shares. Okay, so it will be how many shares? 1200 plus the additional that it's issuing, 667. $2. Okay, $2 will be the per share value, or if we just open it up, 2.28. Right? Combined entity as in that is Lala at the end of the day because it's acquiring the entity. So per share value of the combined entity. Okay. Combined entity being Lala company post acquisition. Right. So how much are Kawa company shareholders gaining? So the gain to Kawa company shareholders will be, now they are getting how much? 2.28 for every 667 shares. Okay, this is what they are gonna gain, or rather, this is what they are going to receive. Okay, value that they are going to receive. Now, what is the gain on this, right? How much are they going to gain on it? So, Kava company's original, you could just say that 667 million weight additional shares issued by. So, Kava company is getting 667 shares. So, we could say value received by Kava company shareholders is 667 into 2.28. This is what they are going to receive. Now, if we want to find out gain to Kava company would be now, what is their original? We have share price of them being point. This is pre-acquisition. Wait, gain by other cash of original Kava company's original share value was 0.6. Okay, so in this case we did a 0.6 and then the new share price was, this is pre-acquisition. There's the combined entities. Yeah, okay, this is 0.66. Okay, all right. So is equal to 2.22. Now, if we just look at per share value, is 0.6 into 3. This is per share. Okay, $0.48 per share. That means what is happening is they are getting $2.28 for how many shares? 3 shares. Okay, and 3 shares were worth 0.06. In fact, we could just cell refer. Okay, so 0.48 is the per share value. So what is the uh, growth that they are enjoying? So the gain is this divided by, now what was their original for 3 shares they would be getting? They're originally getting 60 cents for 3 shares. Okay, so their total gain is going to be 26.6% or 27%. Okay, this is in case of I think I'm going super slow for this. The other questions we need to rush. All right. So 27%. But anyways, it's valuation, mergers, acquisitions. So let's take it slow. It's the first time we are doing a Section A type of question for it. Yesterday we did investment appraisal. So I think the Section B will have investment appraisal and risk management. because they are for sure going to come, right? So 27% is the gain of Kava company. You can actually, we can just, this is Kava, Lala, and in this case, what would the Lala company gain? So gain to Lala company's shareholders, okay, from acquisition in case of share for share offer. I'm just writing it short. Okay. Now what they are getting is their share price has increased to 2.8. Okay. So from what was it originally worth? They were originally worth per share value of, okay, the per share value we haven't, yeah, okay. No, this is after, okay, let's just find out the per share value of Lala. Okay, if the total, so that means Lala's current, how did you find this is per share value? Yeah, okay, we have done it here already. Okay, so it'll be the new share price divided by the original share price before acquisition minus 1. So 13.83% or 14%. So this is the gain to Lala company shareholders after acquisition. This is pre-acquisition per share. And this is post-acquisition. All right. So the gain over here for Lala company shareholders is a little less, whereas in this case it is more favorable for Kava company shareholders. So Kava company shareholders would definitely want this one. Okay, but would Lala company shareholders favor it? Actually, they can because they are also experiencing some because if they give this offer, it will get rejected. Sorry, Kava would rather demerge the entity. Okay, but if they do share for share, it's 27%, which is much more than 17% over here, right? So, or since everything is in a single decimal, we can just 18%. Okay, so 27% is much better than 18%. So they would want this share for share deal. They would readily accept. So all this thing you can write in your conclusion part. Now they also asked us to find the impact on the capital structure if it goes for cash funding and debt funding. Sorry, cash funding and share funding for Lala company. Okay, so we can write this as a new appendix. Appendix 3. This can be Appendix 4. All right. estimate of impact on the capital structure of Lala Co. from two payment methods. Okay. So Lala company before acquisition, what was the case? ACQUISITIUN before acquisition. Okay. So market value of equity was, and what was the market value of debt? Okay. So the market value of equity was before acquisition, it was $2,402 million. Okay. What was the market value of debt? Now we had the debt to equity ratio. I'd written it somewhere. 40:60. Okay, so using that, we can calculate what is the market value of debt. So is equal to this into 60 divided by 40 is equal to 3,000. 604. No, wait, there's something off. Debt is debt to equity 60% debt, 40% equity. Yeah, okay. So we could write this. Yeah, this is the market value of debt. Now, Lala company, okay, wait. Sorry, made a mistake. It's 40 into 6, 40 by 60, not 60 by 40. Yeah, Lala companies before acquisition is, so it's very simple. If this, so see, the ratio says that debt is 40%, equity is 60%. So if this is 60% and this is 40%, it's a simple cross multiplication, this into this divided by this. Okay, $1,602 million. Now, Lala company is after acquisition. Okay, uh, if we do cash payment. Okay, if cash payment is done, then what will be the value of Lala companies? All right. So, firstly, we'll calculate market value of equity. Market value of equity. So, we have already calculated that the market value of equity after acquisition will be $4,254 million. Okay. This is the market value of equity. Now, we need the market value of debt for the company. So, market value of debt. Okay. So, what will be the market value of debt? So, it will take its original market value plus we assume that it takes the market value of the debt, or because it's acquiring Kava company. So, Kava company's debt it will take. Okay. So, what we'll do is, let me just on acquisition, it's going to acquire Kava company's debt also, $400 million. All right. So market value of debt of Lala post acquisition. Okay. This debt plus this 2002 million dollars is what it is going to be. Right. So total value of the firm. Okay. So total value of the combined entity will be value of debt plus value of equity, right, will be 6,255 million. So if you had to find out the percentage, okay, 68%. Oh, one more thing, since it's a cash payment, it will be less the cash payment. So how much cash is being offered? Okay, so oh wait, does this already? I think this already considers that cash, right? Wait. Yeah, this already considers everything, so we need not do that. Okay, and right, so debt to equity level will be 68% equity and 32% debt if cash payment is done. Now, wait, market value of debt is, and then one more thing was that we would take whatever we are paying as cash is also taken as a debt. It was a sentence given over here. Lala company will borrow the money needed to pay for the acquisition. So it's paying these many $1 million. Okay, so that will be borrowed. So this will be the final one. So debt will be, I think, um, get this right, 4,002 and then 3,321 million dollars. Okay, so this will be the debt and this will be the market value of Lala post acquisition. Wait, not the combined entity. We just want Lala. So many figures over here. Wait. If cash offer is done, what is the value of Lala? 2,934. Okay. So 47% and 53% will be the debt to equity structure. So originally it was 60-40, and it will shift to 47, 53%. Okay. And Lala company after acquisition, share for share. Okay. So in case of if it is share for share, then market value of Lala company post acquisition. What is the market value? Combined entity is this much. So market value will be $4,254 million. Okay, over here I accidentally had initially taken market value for share to for share offer. We had to take cash offer. So yeah. So this is share for share. Market value of equity for Lala company will be this much. And market value of debt for Lala company is going to be now it's not acquiring anything. So it's just going to be this plus, as in it's not giving any cash, so it need not borrow anything extra. So it will be just those two. All right. And if you have to see the market value total MV of the combined entity. Okay, so total market value of the combined entity will be 68 and 32. So if you see over here that 32% debt and 68% equity. So now it depends what is the cost of debt. We don't have information on that. What would be the WACC? But if they want to have a mix, okay, this is rather more closer to their original structure. Okay, from 40 it is becoming 32, but here it is increasing to 53. Okay, this is a 13% increase in debt, whereas here it is a 32% reduction in debt. Now, depending on what they want to do, if they want to maintain this, then this is better. Okay, so from share structure wise or corporate structure wise, also share for share deal is better, and also share for share deal is good for the shareholders of Kava Company. So, accordingly, you can draft a report. Since there is a lack of time, we will move on to the next question. All right. I hope this is clear. So we can say that this is the main thing over here. All right. This is the equity debt ratio. This is our debt to equity ratio over here. Okay. We'll take a 10 minutes break. I understand it was a big question. We'll take a 10 minutes break and then continue. Right. Okay, welcome back. Now section B. So these are the instructions. Now scenario: calculate the APV of the investment and recommend whether the project should be accepted or not. Discuss the factors the capital providers, excluding banks, will consider before deciding whether to approve the funding decision for option companies' investment in manufacturing plant. So all the factors that affect your funding. Okay, it's a theory question, so uh, you can be very generic, but let's read the question and we can try to relate it also to the. Actually, you must be relating it to the question. So, Robson Company is a food manufacturer with a portfolio of well-known brands. The founding directors retain a significant minority shareholding in the company and continues to serve in the board following a successful listing 10 years ago. After obtaining the listing, Robson Company's gearing ratio increased significantly above the sector's average as a result of poorly timed expansion strategy, mainly financed by debt. Earnings became increasingly volatile, and the debt burden triggered a decline in the company's financial performance. The board responded to these problems 5 years ago by pursuing a debt reduction turnaround strategy, which has been financed by a series of right issues and asset disposals. Even though this strategy successfully reduced the gearing ratio, which is now equal to the industry average, the share price remains depressed due to competitive pressures within the industry. The company's credit rating has recently been downgraded. Once again, Robson CEO has identified an opportunity to relocate manufacturing plant and develop a state-of-the-art automated production line, which will reduce the underlying cost base and be a source of competitive advantage. So the project information, Robson Company's finance director has prepared estimates of free cash flows generated by the project based on 4-year horizon. So free cash flows are already given to us. We need not what do you say, have to find out what the sales or anything is. We already have the cash flows. Now, the investment cost is $120 million, which Robson Company CEO proposes to finance as follows. So we can just write this, copy paste this over here. Okay. Uh, right. These are our free cash flows. Okay. $1 million. And then they said our initial investment is $120 million. Or we could just write it there. Okay, $120 million is our initial investment, right? The rest all are inflows. Yeah, these are all in dollar terms, right? Okay, one decimal space. Yeah. Uh, so initial investment is 120 million. It's funded by 20 million disposing of a plant, 10 million right issue, 40 million subsidized loan, and 50 million uh, as a bank loan, a regular loan, which is at 9%, and subsidized is at 3.5%. Okay. The bank loan is repayable in equal annual installments over 4 years. So the bank loan is basically EMI sort of thing. Okay, so we have to calculate those. Issue costs of 2% are payable on gross external financing are not allowed for corporate tax. Issue costs are payable out of available cash reserves. Okay, so the finance director has asked you to ignore underwriting costs relating to the right issue. Additional information options: current equity beta is 1.418 and the debt to equity ratio is 1.5 based on market values. Risk-free rate is 3% and the market premium is 9%. The CEO expects the business risk of the company to remain unchanged as a result of investment. Co- Tax is 20%. Okay, so we have our free cash flows. Now let's find out our cost of equity. Okay, so cost of equity now. in APV, we assume that the base case NPV is basically an all equity financed project. Okay, so we need the asset beta, right? So asset beta. In fact, you can call this as a working note or an appendix. So we can just call it working note 1. You need to label it. So that's very important. So working note 1, asset beta or estimating asset beta, whatever. I'm just saving time here now. So asset beta, for asset beta, we have our equity beta. Equity beta is 1.418. Okay. And debt to equity is 1:5. Okay. Okay. So let's just directly calculate it. So asset beta is equal to equity beta into 1 divided by 1 plus 5 into 1 minus t. That is 1 minus 2. Okay. This thing, I'll put the whole thing in a bracket. Right. So my asset beta is sent. Well, that's too high. An asset beta, there's some mistake I've made over here. The brackets mostly. Wait, I'll just do it again. This into value of equity 1 divided by 1 plus 5. Okay. Into, I'll just do it directly 0.8. Right? Yeah. So this is my asset beta. Again, it's 7.9. Wait a minute. I just manually do it over here. My equity is, wait, am I getting the ratio right? Oh, debt was 1 and equity is 5. Okay, that's why the mistake. Equity is 5. This is 1. Okay, so wait, again, it is wrong. How is my asset beta more than equity beta? Wait, yeah, this seems proper. Okay, 1.2222 is my asset beta. All right, I just made certain mistakes with the debt to equity ratio. Once I fixed that, I got my right answer. Right? So that's my asset beta. Now moving on, my cost of equity. So cost of equity will be um, risk-free rate. So risk-free rate is 3% plus beta into market premium. So market premium is 9%. Okay, so cost of equity is 14%. All right. So we will discount these cash flows at 14%. So NPV at 14%, all right, is equal to NPV 14% my cash flows, okay, minus. So, sorry, not minus, since already it's a negative sign. So I'll add, okay, 4.51 is my NPV, okay, base case NPV that we say. Can highlight this as one. So my base case NPV at 14% is $4.5 million negative. Right. Now moving on, what will our this thing, or we can just write a statement. So base case NPV is equal to minus dollar 4.5 million. Okay. Base case NPV is negative, and on this basis, the project is rejected. Okay, because it's negative, right? However, we will show the financing side effects. Okay, we are asked to calculate the APV. So we will show the financing side effects to it. Now, these are working notes, so we can write it at the very end. In fact, in the exam, you won't be able to add rows or anything of that sort. What you can do is you can do the calculation wherever, and then later on, you can shift it on the side or shift it on the bottom. Okay. So financing side effects $1 million. All right. So usually we'll just prepare our issue costs. We also have subsidized loans. So tax shield. Tax shield will be on both subsidized loan, SUB, SID, ISCD, subsidized loans, and bank loans. Okay, and benefit on subsidized loan. Okay, subsidy benefit. Okay. So firstly, our issue costs. So we can move on to the next working capital. Working capital, oops. Working capital 1, working capital 2. We are discounting it with cost of equity because it is an all equity financed company. Therefore, we took asset beta also. Okay, so issue cost will be. So for issue cost, they have said what is our issue cost? Where was it? 2% payable on gross external financing. Okay. So what is the gross external financing that we need? Now, if we see the gross, 20 million is the sale of machinery. So we are just left with this. So 120 minus 20 is equal to $100 million or is the gross financing required, right? So issue cost will be 100 million. We can just write it. Or gross funding will be $100 million, and issue cost will be, okay, this is already gross, so we don't have to do 2T8 or anything of that sort. outflow will be okay. You can also say that it's in working note 2. All right. Now moving on, the tax shield. So tax shield for firstly the subsidized loan. So tax shield for subsidized loan. Okay. Now we have to find the present value of the tax shield. It's actually PV of the tax shield. Okay. So we are going to get same tax shield as in we are going to take a loan for how many years was it? It's a 4-year project. So I'm assuming 4 years. Is it written? Over 4 years. Okay. Regular loan. So we are assuming that even subsidized loan. Now I don't have time to find out where it's written, but if it's not written, we will assume it's a 4-year loan. Okay. So we need the annuity factor. Now, annuity factor we can either take on the regular loan or we can take it on the risk-free rate. Okay, we will take it on the regular loan. So annuity factor, okay, 9%, 4 years. Sorry, right? 9%, 4 years. So 9%, 4 years happens to be 3.24. 3.24. Okay. Now, what is our interest? So interest is, or rather subsidized interest. We are taking a funding of $40 million, paying an interest rate of 3.5%. Okay, so that's our interest. Then we need to, we are finding the tax shield. Okay, so tax shield will be this into 20%. Again, you can do it directly. I'm just showing steps over here. This is the tax shield. So PV of tax shield on subsidized loan. Okay, so PV of tax shield. So tax shield is this into the annuity factor. So point $907 million. Okay, that will be our tax shield. So tax shield is equal to, we can just show it to one decimal place. Okay, these are all in million dollars. Just highlight the main answers. Right, next tax shield for normal loan. Okay, now for a regular bank loan. Okay, so over here you can just write one right before we do bank loan. Okay, just write that note for professional marks. Okay, the risk-free rate would also, or we are discounting with the uh, regular, the normal rather, normal bank loan rate we could also use the risk-free rate for discounting. So just making the examiner aware that you know that we can use the risk-free rate also. Right, so tax shield for the regular bank loan. Now, what is our annual payment or EMI? Annual repayment or EMI basically. Okay, so EMI will be whatever the value you have to pay back, that's $50 million, divided by the annuity factor. So annuity factor, we have calculated it already. We found it out over here. So our um, annuity is these many $1 million. Wait a moment. All right. Sorry about that. So let's continue. So our annual EMI was $15.43 million. Okay. So now if we have to find out the tax, because tax benefit is available only on the interest repayment, not the principal repayment. Okay. So what we can do is here, how did we do it here? Right. So we have years 1, 2, 3, 4. Now we can just write our opening balance. So initially we took a $50 million loan. Now all figures are in million dollars. Okay, opening 50 million, from which we paid repayment was, we are repaying 15.43. Okay, but out of this repayment, there is a component of interest and a component of principal. Okay, so interest was 9% interest. So we were actually paying out of that 15.43, we paid $4.5 million as interest. Okay, so now our closing balance will be out of 50, we are just paying 4.5 as interest. And the balance was, the balance was principal repayment. So out of this, we need not include the interest component of it. Okay, so 39.06 is the, now you can do it directly this way, or we could say that principal repayment was then, okay, so our closing balance will be this minus the principal that we repaid. That's 39 point. It's going to be the same. So either you can do it directly or show it off this way. All right. Now, whatever our closing will be, will become our, we can, this will be the same because we are going to repay the same amount always. This also formula, wait, okay, I think we can just, interest also, it will be now 3.5. So we can just copy paste everything. All right. Our closing balance eventually is becoming 0. Now, what we want is interest. We are interested is in interest. Okay. So tax relief on this interest, which is 20%, is the relief that we are going to get. Okay. So this is our tax relief. Now we need the present value of the tax shield. So PV will be is equal to NPV. Now you could individually discount, or we can use the NPV formula. It's the same thing. Okay. So the present value, we are going to discount it at 9%. Okay. And select all our cash flows. So 1.98 will be our present value of the tax shield on bank loans. Okay. So we can write it down in our, for bank loans, the tax relief that we are enjoying is $1.98 million. Okay. Now let's move on. What is the next one we had to calculate is, yeah, so subsidy benefit. Now, what benefit are you getting because of subsidized loan? The benefit you're getting is decreased. Oh, wait. This is working note number 4. Remember, when you are copy pasting, keep your numbering intact. Working note number 5. Okay. So subsidy benefit. Now, subsidy benefit. So how much is the subsidized loan? $40 million into, what is the difference between the rates? 9% minus 3.5%. Okay. Into 1 minus T because it's post-tax. All right. And the present value. So the annuity factor is this. Right. So this will be the subsidy benefit that we are getting. Right. Okay, so we can just add it. Right. Okay, so our APV will be the summation of all of these. Okay, let me just check the sign. Negative, this is an outflow. Over here, we can write WN3, WN4, and WN5. This is PV. Okay, so APV will be $6.59 million. So since we are getting subsidized loan, okay, this project is beneficial. Okay, so here we can write our final recommendation that the the APV of the project is $6.59 million. So we can accept it. Again, you are supposed to give the entire picture. I'm just writing it in short because we haven't really read the entire question, okay, properly. But since we are short of time, just know, like, see how we previously have structured conclusions, even in previous day, you can take cues from there and write it accordingly. Okay, given the above figures and estimates, we are assuming or we have estimated an APV of 6.59 million, which is positive, and therefore we can accept this project. However, do note that the base case NPV was negative. So this is provided that we are getting the subsidy benefit because that's the major one, which is adding that uh, positiveness to the whole cash flow. All right. So we could just say this is our recommend. Okay, moving on to the next question. Now, the board discussed the financing of the project. So this is project B or question number B, okay, which speaks about what is the question? I think it was the what are factors you would consider before discuss the factors the capital providers, excluding the bank, will consider before deciding whether to approve the funding or not. Okay, so all the external factors like shareholders, loan providers, whatever. Okay, so we can discuss that again due to shortage of time. We won't delve into it, nor am I even reading it, but you can read into it, refer to your notes, and you will easily be able to answer this. Okay, we will move on to the next question that is on hedging. Okay, so advise Gogart company on and recommend. Okay, we'll just quickly just read over here. Wait, let me just see. Are you guys okay? Do you want me to read this or you think you can do it on your own because it's just theory? Okay. I know you need practice and theory, but there is very little that I need to explain over here. You can just refer to your notes and give it. All right. Otherwise, the class will get extended and then I have another class as well. Okay. Actually, we'll just proceed. If there is time, we'll come back to it. Advise Gogart company on and recommend an appropriate hedging strategy for its US dollar cash flow on the 31st, include relevant calculations, discuss the advantage and disadvantages for Gogart company in using the ETF, exchange traded currency options compared to using OTC currency options. And so OTC currency options will be options on forwards, and exchange traded will be options on your futures. Okay, so what are the advantages and disadvantages of that? And discuss the role of the treasury function. So in the management of economic risk. So if you have observed, even yesterday's paper had a question on role of treasury functions, or rather centralized advantage of centralized treasury function. Okay, so let's start. Gogart company is an elect. Okay, somebody's asking for a break. We just took a break. Okay, fine. We'll take a 5 minutes break. Okay, a quick 5 minutes break we'll take, not a 10-1. So a quick 5 minutes break. All right. Be back in 5. All right, welcome back. So let's continue. So Gogart Company is an electrical equipment manufacturer based in Malaysia, looking to develop its operations abroad. One of its biggest sales market in the US, and Gogart also imports components from the US. Gogart Company regularly hedges transactions in foreign currency. It is currently 1st of May. On 31st August, Gogart is due to pay $14.5 million to an American supplier and receive $37.4 million from an American customer. Okay, so it's going to receive and pay as in on the same date, so we can have a net exposure. Okay, so we can say what is our net now. Are we receiving more or giving? We have to pay more. Where is it? Pay 14 and receive more. So net receipt is equal to 37.4 minus 14.5. Okay, so 37.4 minus $14.5 million. Sorry, right? $22.9 million. Okay, or I'll just multiply this whole thing into millions, so then easier to understand. Okay, so $22.9 million is what we are going to receive on a net basis. Now, let's read further. The following quotations have been obtained. The exchange rate quoted as US dollar per Malaysian ringgit is spot is given and future is given. Okay, wait. These rates are actually, this is decimal. Okay, and then space. Okay, this also same. Decimal, space, decimal. Right? So spot rates and forward rates are given. Currency futures are given. Now June or September, again, these are decimals. Okay, June and September futures are given. Currency options are given. Exercise price is given over here. Okay, exercise price, again, this is decimal. So our strike price, and then we have the premiums for our options. Sorry, what is it? 0.11. Okay, so these are our premiums given. Now, futures and option contracts mature at the same month, and the number of contracts to be used should be rounded to the nearest whole number in calculations. If the amount cannot be hedged using an exact number of futures or options, the amount under hedge or overhead should be hedged using the forward markets. Okay. So for the purpose of calculation, it should be assumed that options are exercised. All right. So they have already given us, sorry, they have already given us the decision that we must exercise the options. So we need not make that decision, which is an odd thing, but well, okay, we got a question like that. Right. So, and if there is any over or under hedging, then we will hedge it using the forward market rates. All right. Clear? Now, let's solve. So, firstly, the forward markets, of, as in hedging with forward market contract. Okay. So, let's say hedging the net receipt with forward contracts. Okay, forward contract hedging is relatively very simple. Okay, you are just effectively hedging, as in effectively fixing a rate. Okay, so if you have these two rates available, okay, we just need to understand that which rate applies to us. Okay, whether it's 0.2370 or 0.2374 Malaysian ringgit. Okay, or MR. Now the quotation, sorry, this is quoted as dollars. So these are dollars and per 1 MR. So 1 MR is equal to either 0.2370 and 0.2374. Now ask yourself that if we are going to receive dollars, that means we are going to the bank, our Malaysian bank, and we are going to sell the dollars. The bank is going to take as many dollars as possible and give us as little ringgits as possible. Okay. So how many dollars will it take? It's going to take as many dollars as possible. So if you have to write this down, okay, this is just for your understanding. One, sorry, MR is one. Okay, how much is the dollar? It's either 0.2370 or 0.2374. Or it is 0.2374. Okay, right? These are the two available quotations for us. Now, think of it logically. If you have to pay, wait, let me just align this. All right. Okay, think of it logically. If you have to, you are receiving $1 million. Okay, or let's put this only. A net receipt is, right? So just have to cross multiply and same thing here. Okay. So obviously the bank wants to make more money. So bank is going to say that it will give us as little MR as possible. Okay, now these are not dollars, these are MR. Okay. So which is less? This is 96, 624, 473. So 624 versus 660, 461. Wait, 96, 624, 461. Okay, so it is going to give us as less. So that means this quotation applies to us. So this is one foolproof way of understanding that which rate needs to be taken. It will just take you a minute or so, or maybe less, to do this calculation. Okay, but it is guaranteed that you are going to, sorry, it is guaranteed that you are going to get your correct answer. All right, so now we know that this is, see, otherwise there are other ways of remembering. Okay, so in the text it is written, I think the bank will always buy low or buy high and sell low. Okay, and otherwise my logical way of thinking is that you just imagine that you have dollars and you are going to the bank, so the banker is going to take as many dollars as possible and give you as little MR as possible. Okay, so as much dollars as, so more dollars is going to take from you and going to give you only 1 MR in return. Okay, it's not going to take less dollars from you. Right, so our forward or net receipts in MR when hedging with forwards. Okay, so our net receipt will be, now we have already done the calculation over here, so we can just write it directly from here. 9641. So these many MR, 96,400, or rather 96,461,668 million MR is what we are going to receive. So we can just mark this. All right. Now moving on, hedging with hedging the net receipts with futures contract. Okay. So now for futures contract, the first questions that we need to answer is how many contracts, which expiry, okay, all of that. So how many contracts? Firstly, which expiry? So currency of the future, currency futures, contract sizes. So the underlying over here is MR, okay, or the currency of the contract is MR. Future price is quoted as 1 MR is how many dollars. Now, they have, so we have June or September. When is the transaction happening? Because we are going to select the one which is immediately after the expiry. The expiry which is immediately after the transaction date. So the transaction 31st August. So immediately after August, May, June. Okay, not September. We are going to stick to June contracts. All right. So we are going to buy March, April, May, June. Oh, sorry. May, June, July, August, then September. Sorry, my bad. We are going to take September. So it's August just now. Immediately after August is September, not June. I don't know what was I thinking. Okay, so we will. And then the next question is, do we have to buy or sell? Do we? So firstly, buy or sell futures. Okay, so we are going to. Now, what is the underlying? Underlying is MR. Now, MR is some. We are not going to have MR, as in we are going to get dollars. So we will be selling dollars and buying MR. Okay, so we will be buying as we'll be buying MR, which is the currency of the contract. Okay. Then how many lots, or rather which expiry? So it is September expiry. Okay. As it's the expiry immediately after the transaction date of, what was the date? 31st August. Okay. Now, how many lots? Again, you can just write it directly, but since I'm explaining, so I'm writing it this way. So how many lots? Now, what is the receipts that you are expecting in MR? So you're expecting how many million dollars? $22.9 million is what you are expecting. And if we have to convert it to uh, MR terms, then how much are we to receive? Okay, 2 point. Now, what is the exchange rate? Are we going to use the futures rate? Okay, or are we going to use the forward rate or the spot rate? So that's the question. All right. So we are going to use the forward rates to convert that. Okay. So if we have to select which one, we have already selected 0.2374. So we are going to convert our receipts over here. So for this answer, let us first say our expected receipt 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 in USD will be okay. Expected receipt in MR will be okay. So this divided by this rate. So we are expecting, now this is not dollars, this will be MR. Okay, so we are expecting these many MRs. And lot size, which is an MR, happens to be 500,000. All right. That's our lot size per lot. Okay. So how many lots? Now we can easily answer this question. We have a requirement of these many MR, and one lot is for 500,000 MR. So 192.3, okay, lots are what we are going to take. Now understand this, that actually we are over hedging. So that is 193 lots. Okay. So we are actually over hedging. So we can just write a statement. The company shall buy 193 lots of September. What's the rate? 0.2378 futures. Okay. So we are going to buy these futures. Now the basis risk. Okay. So basis calculation. We assume that basis reduces to 0 on maturity at a constant linear rate every month. Okay, so we have given our assumption, again professional marks. So what is our current basis? For current basis, now we already know the future price. Okay, what we can do is spot future, and this is today. Okay, so today, what is our future? Our future price is 0.2378. Okay, and what is our spot? Now, which one do we have to take? 0.2355 or 0.2358. Okay, this is for every $1 MR. Okay, so we have already decided over here it's the higher rate, so we can use the same logic. 0.2358. Okay, that's our spot. So our basis, unexpired basis, will be our unexpired basis will be spot minus future. Okay, so this will be our unexpired basis. Now months left for expiry. So today, what is the date? We are at 1st of May. Okay, expiry is in the end of September. So first May, entire month, May, June, July, August, and September. So 5 months for expiry. Right? If you want, you can just write it. This is 1st May. And then the transaction is happening on 31st August. 31st August. And 30th September is the expiry. This is the transaction date. Okay. Right. So we know that on unexpired, on future date, we don't know what it's going to be, but we know that it's going to become 0. Okay. So what is the unexpired now? How many months left for expiry from 31st August? So August, May, June, July, August, and just 1 month. So September. Okay, 1 month. So like a cross multiplication. All right. So this is the unexpired basis as on 31st August. Now, do we have the spot rate as on 31st August? Spot over here is only given. Any other spot rates are given, futures and options. No. So what we can do is we can use our shortcut method. Okay, if you remember our shortcut rate, the lock-in rate. Okay, so lock-in rate is lock-in rate is equal to opening or current future price minus unexpired basis as on transaction date. Okay, so this is the formula for lock-in rate. I hope you remember it from our class. Now we can just directly, since we don't have the spot value, we cannot find future rate with the normal way. So we can use this shortcut way and find it out. Anyways, in option, they have given us that we have to exercise it. So even if spot was available, we need not do all this. We can directly use the shortcut method and get it. So futures lock-in rate will be the current future price minus the unexpired basis, so which is 0.2382. Now, unexpired basis is already written in minus, so I think we can just add the two. Okay, so 0.2374 will be our final answer. Wait, unexpired basis is what minus. Yeah, this is already given in negative terms, so we will just write it as is. All right, so 0.2374 is our lock-in future rate. Let me just bold it. Okay. Now we will convert our shares. Okay, so if you have to see that how much are we, so in futures, what's happening? We have hedged for 500,000 MRs. Okay, into 193 contracts. Okay, so what is happening is 500,000 into 193. Okay, so sorry, not into, divided, right? Wait. So we know that this is our locked in rate, which means uh, these rates are quoted as every 1 MR is equal to these many dollars. Okay, 1 MR is equal to 0.2374 dollars. Okay, so wait, is it the same as above? 2374, yeah, 0.2374. Okay, it's the same rate. Okay, so we can say that, but understand this, we are hedging for 193 contracts. Okay, so number of contracts is 193. So we will say that, wait, before we do futures, we are over hedging. So let's calculate that also. Okay, so amount over hedged. Okay. Now, how much amount are we over hedging? So, we are hedging for $500,000. Sorry, 500,000. One lot is 500,000 MR into 193 lots is what we are hedging into. Now, we know that the rate that we are locking in is 0.23. In fact, our lock-in rate and our what do you say? Our forward rate is the same. Okay. So we know that the same, that is 0.2374 is what we are hedging for. Okay. But what is the requirement? The requirement is to hedge only this much, this many dollars. Okay. So we are hedging extra $9,100. Okay. So payment at forward rate. Okay. So payment will be at the forward rate. Now we have $9,100 is what we need to hedge. Okay. What is the rate at which we are going to hedge it? So rate at which we are going to hedge it is not hedge, sorry, we are going to transact is, now understand this, these many dollars we are getting. Okay. We will go to the bank and now this will be done at the current spot rate. Okay. The spot forward rate is 0.3, spot forward rate, currency futures, price quoted, option premium. Okay, the spot rates are not given, and they said that should be hedged using the forward market rates. Okay, any unhedged or should be hedged using the forward market rates. So we know that we are going to hedge it at 0.2374. Okay, so we are going to, so that's the balance that we are going to hedge it at is payment at, so this divided by, now for every dollars, okay, we have extra dollars with us, as in, no, actually we have hedge for MR. Okay, see, we have, what is happening is amount over hedged in dollar is 9,100, or we can just write it in MR form. That'll be easier for you to understand. Okay, 38,332 MR is what we are hedging for. But no, we need everything in, yeah, MR terms. Okay, so we are hedging, amount over hedge is this much, these many MR, 38, 332, right? We are hedging 193 lots. And there is a expected receipt of 96, but this should be hedged. Expected receipt will be at, understand this expected receipt will be at, here the rates were same, but it's at this lock-in rate. Okay, so it'll be the same, but just letting you know. Okay, so this is the amount that we are over hedging, and this one is actually hedged. So if we just say that our outcome will be, now in the futures market, okay, what is happening in the futures market? 93 lots is what we hedged, okay, into 500,000. Okay, now what is the benefit that we are receiving? Okay, wait just a moment, I think I am having, My net is weak. We'll just okay. Let's just wait for it. I'm just switching the screen. Once it's back, we'll continue. Okay, I think the net is more stable. So this amount overhedge. So wait a minute. Again, there is some issue. Wait. I think it should be back in some time. Wait. Okay, now I have a green light. Hopefully it remains. Okay. So anyways, we were saying that amount overhead. So if you want to write it in dollar terms, these are in MR. Okay. You can also write it in amount overhedged. Okay, is equal to. Now we hedged for 193 contracts at a rate of 0.2374. That's our lock-in rate. Okay, but we were supposed to be hedging only for 22,000. What was it? We were supposed to be hedging only for this much. Okay, so $9,100 is what we have overhedge for. So this is actually the payment. You can say payment at forward rate. Okay, it's the same. So even if you do the payment way wherein you are saying that, oh, I have to pay this much divided by the future rate, sorry, forward rate. So forward rate was 0.2374. Okay, so 38,332. So you will get the same answer. It's not going to change. Sorry. Okay. So MR is going to remain the same. Now your future market, what is happening? $500,000. Sorry, 500,000 MR has been received. Okay. This is all in MR. Okay. And payment on over hedging. Okay, because you have hedged extra, right? So your total on net will be okay 96,461,000 MR. Okay, so this will be, so we can write a conclusion. When hedging with futures. So if you see that 96,461 versus 96,461, 668, 668. Oh, it's the same. Yeah, seems to be almost same. Okay, because yeah, so the rates were lock-in rates were same, so it got similar. Even this is being your payment is being done at the forward. Whatever they said that over hedging, whatever you are doing, that is done in your forward rate, so it will be the same. Because if you see our lock-in rate as a lock-in rate, yeah, our 2.374 and this rate over here is the same. Therefore, the answers are also the same. Okay. And even the over hedging is done on the the over hedge portion is further hedged with the this thing, what do you say, forward rate. It's mentioned in the question. Okay, so therefore it is the same. Now moving on to options. Okay, so they have clearly said that, so hedging with new receipt with options. Now for option, they have clearly said that we are going to exercise the options. Okay, so now for our questions. Okay, instead of buy or sell, buy, call, or put options. Okay, so what is the underlying? The underlying for put for options are 500,000 MR. Okay, so MR, what do we now? It's the same underlying as futures. So in futures we bought. So going to buy call options. Okay, you can write the reason why, because we need to buy MR. So the underlying, the currency of the contract is buy. So you can write that. Okay, which expiry immediately after the transaction date. So again, August. So September. So it'll be September expiry. Now, how many lots? We'll be using the same calculation as above. Okay, so we can use the same way in which we are doing it. So receipt was, if you want, you can just write it again. So receipt it will be, oh, so over here now it won't be same as in answer is same, but receipt uh in MR will be 22,900 divided by, now what is the strike price of this? Okay, where is it? 0.2368. So 0.2368 is the rate at which you can convert it since you're going to exercise it. So that's the rate that you're going to get. So your receipt is going to be this much. Therefore, how many lots will be this divided by the lot size, that's 500,000. Okay, so 193.41, that is 193 lots. Okay, so keep this in mind, 193. So here we are over hedging by 0.41, right? Or rather under hedging, not over hedging, under hedging by 0.41 contracts. So we can write our statement. Uh, where was it? So the company shall buy by, okay, wait, 193 lots of call September options, and the rate is what's the exercise price? 0.2368. Okay. So this is what the company is going to do and pay a premium also. So premium paid will be 193 lots into, okay, now what is the premium that it's paying? 0.14. Okay, that's into 0.14 divided by 100 into lot. So one lot is for $500,000. Okay, we're doing 193 lots. So the premium paid will be $135,000. Okay, because these are quoted in dollar terms, the premium. Okay, see here they have written in cents. Okay, so that's why we did divide by 100 also. Okay, so premium that we are going to pay is 135,100. Now premium paid in MR terms will be, so we can just convert it. This now, remember this premium is paid today. Okay, today's spot rate because it's paid today, right? So this divided by the spot rate. So our spot rate currently is 0.2355. Okay, so 0.2355. All right. So we are going to pay that many MR. This is not dollars. This is MR. Okay. Now moving on. So premium paid is done. We are already exercising, so we know what is the receipt in MR. Now the element which is being overhedged. Okay. What is being paid? So amount underhedged. Sorry, underhedged will be. We know that there is a requirement of only these many dollars, but we have overhedged it with 193 contracts into 500,000 and our lock-in rate was 0.22368. Okay. So the amount under hedge is $48,800. So if we have to translate it or convert it into forward rate, so you can just write it over here. Okay. So now we have to do it at forward rate. So 0.2374. Okay. This is MR. Okay. So this is actually a receipt because we are receiving, what do you say? Oh, okay. So in that case, this won't be point. This will not be, wait. Okay. Sorry. See, this is a payment, not a receipt. Okay. So when we were doing our calculations, we were hedging for a receipt and we selected this rate. So it will be this rate. Okay. This is a payment, right? So therefore, this gets a little more than our 461,668. This is 461,603 MR. Okay, so slightly less futures. Okay, now receipt at forward rate will be 205, 560 MR. Sorry, I just didn't realize that it was a payment in hurry. I just did the calculations. Okay, so in case of options, our outcome in MR. So options exercise, we are getting 193 lots and we are getting 500,000, the underlying. Okay, so we are getting these many MR over there. Then receipts in the forward market, because of under hedging, is this much. Okay, and premium paid is this. So that's the only outflow. You can say this plus this minus this. Okay, so 96, 193 is the total. Sorry. Right? Okay, so we can say now if you look at our which is the least, so 96,131, sorry, which is the most, because we want the most MRs on conversion. So this is 96,131. This is 96,461, 603. This is 668. Okay, so we are going to get the most in forward hedging, right? So we will say that recommendation will be, okay. Now here again, do not write a one line recommendation. Give the complete picture that forward rate, as per the calculations above, forward rate gives the most MRs on conversion of the US dollar receipt, okay, net receipt. And therefore, we will recommend this. But please note that it is very marginal. So the forward and the future, if you see, it's very marginal. However, we prefer forwards because Firstly, it is standardized, so there is no problem of over or under hedging. Okay. Secondly, futures are exposed to basis risk. Okay. So maybe our lock-in rate, as in maybe the unexpired basis is not 4, as in we have calculated this making an assumption. So reality, it does not go down in a linear manner. Okay. So we are faced to that risk. Options is the highest. However, if there was a favorable change in rates, okay, or foreign exchange, then options may be beneficial. So we need to see which scenario has a higher probability. So we could write that as our um conclusion. Okay, so that's your entire calculation. Your entire conclusion should be like. Now discuss the advantages and disadvantages of ETF instead of OTC. So you don't have. So it's both advantages and disadvantages. So from this text, you can say that and discuss the role of treasury function again. You can do that. We are running short of time. We are way overboard. Okay, so I think we'll just end it here. But again, easy theory questions. You can just read the rest of the case and accordingly give your answers. I hope these calculations are very clear to you and how to write your recommendations. Okay, thank you all for your time. Have a great day ahead. Okay, see you tomorrow. Tomorrow we are doing the last class. Again, we will be doing a paper, full-fledged paper. I guess I will just do the calculation majorly and the theory part, you can do it on your own or we'll just quickly discuss it. Okay.